Hi guys, I'm Stephen Edwards and I'm the Director of Cheltenham Tax Accountants in case you don't know me, don't know who I am. So the reason I am doing this video is I want to talk about the 32 main ways to save tax. It's not a super in-depth tax analysis review, so don't worry, I'm not going to bore you to death with all of the detail. But what I want to do is just make people aware of the main areas and the quick wins that you can save tax. And one of the questions or one of the observations that comes up quite a lot of the time is, surely we're already doing all of these things if we have an accountant. So whether that's ourselves or a different accountant, often it comes up to say, that's what I'm paying you for, or that's what I pay an accountant for. But the truth is, like any business, there's limited resources, and you're not necessarily getting the in-depth sort of review on a regular basis that you expect or you assume is just happening in the background. That the way I would probably explain it best, it's a bit like getting your car serviced. You've got your your three levels, your three tiers, typically your bronze, your silver, and your gold service. And a lot of people just do what they need to pass the MOT. And I hate using the expression and not throwing a lot of accountants under the bus, but there's quite a lot of box tickers out there that are literally doing the minimum in terms of compliance. And compliance is, let's get it filed, let's make sure there's nothing obviously wrong. There will be a natural review as part of that, but typically they're only focused in 2 or 3 areas of the business. So I just want to make you aware of a broader scope of a review you could and should do on your business. We've actually done, just to illustrate the point as much as I can, I've even done a more recent review of my own business, and I'm going to share that story in a blog and probably a video post in the coming weeks. So as I mentioned, there's 32 main ways to save tax. We're not going to go through everything, but I just want to really plant that seed to think about some of the potential easy wins or some of the areas you're missing out on in your business at the moment, or you've not reviewed for some time. So like anything, there's a journey. When you start a business, you're in the startup phase. So in the first year or two, normally the first year, you're a new startup. And I'd say most businesses are probably classed as a startup for the first 2 years, if not longer. And that's a very difficult phase. That's a lot of businesses, I'm sure you've seen the statistics, fail. So if you've gone beyond that, congratulations to you. We've been in business for 7 years. We're proud of that. And I think it's, you've got to move with the times, and it's challenging staying in business. So beyond the startup phase is you've got basically your mature business phase, you're established. And then you've got your growth phase, and you can move through these pretty quickly. They're not always in the same, have to be linear. They can sometimes be a bit out of kilt. You've got the growth stage, and then you've got basically the exiting stage where you're looking to exit your business. They're the 4 main stages. So you've got your growth startup stage, you've got your established stage, you've got your proper growth and expansion stage, and then you've got your exit stage. So 4 main areas. And the tax considerations and tax planning strategies are not going to be the same through each stage of your business life. When you're first starting a business, typically it's things like, and this is the problem with what's happening with a lot of businesses, even now if they've gone beyond the startup stage, a lot of the focus is on dividends here and salary. And probably also, I wouldn't say gifting shares to family, but splitting shares with people in your family. They're the main areas. You could even throw in employing your spouse. So these sort of areas here, these 4 are the main areas a startup would usually consider. Let's get the share structure right. Income splitting in your family, husband and wife, typically. Sometimes children can be involved in that. How much salary should I pay myself? Typically, it's no secret that it tends to be a lower salary and higher dividends, but that's not always the optimum figure. It does depend on your circumstances, and it can change. It depends if you've got other income. And what happens is after a year or two, nothing else happens. The accountant can just pick up the accounts annually, particularly if they don't do the bookkeeping for the business. They're picking it up once a year, and not much is actually changing. They're doing what needs to be done. They're calculating the corporation tax or figuring out the tax if you're self-employed, making sure everything's compliant. Everything's up to date in terms of VAT returns, liabilities. Everything gets reconciled. There's lots of accounting adjustments going on, but there's not this deep tax review of your circumstances. And a lot of the time, it comes down to, I think, fee pressure in the industry. Sometimes everyone's trying to do things cheaper because they want to win work, particularly if you're a new business. I think it's safe to say a lot of us have been there, but when you start a business, you can afford to be cheap and you often undercut other people that are more established, got bigger resources, also obviously more overheads. Because you're cheap at the beginning, that means you can maybe offer that service at not still doing it justice because you've got the time to do it justice. But at some point, something has to give. And a lot of people with price pressure, they're not, long story short, they're not charging enough to actually do a better job for you. It's a bit like it's a false economy, really. It's a bit like paying someone to fix your car and it breaks down in another 6 months' time. We could pay a bit more and get it done properly, really. So unfortunately, that's what happens, is there's not enough time and there's not enough resources for people to really take a deep dive and look at these sort of things. So forget the 32 ways to save tax. We're probably looking at 3 or 4 that most people are looking at on an annual basis. So I've waffled enough. So we're getting to some of the more interesting points that you want to see. Some of you might have seen this guide already and you might have downloaded it already, whether you're an existing client or not. You've just been onto our website. If you've never seen it, if you're an existing client and you're seeing this for the first time, then this is a new thing actually that we're starting to put a lot more focus on. So more than happy for you to get in touch with us and discuss how it affects you, but I will come to that in a second, whether you're a client or not. But I want to add as much value as possible, regardless if I know you personally or the business looks after you at the moment. So just going to cover the main ones, tend to be at the top here, and I've got some more at the bottom. So pensions, that's quite a common topic that gets brought up very often. And, should I have a company pension scheme? Should I have a personal pension scheme? How much should I put through my pension? Should I have an ISA? That all interacts. And how does it work with my pension if I've got another pension? So there's lots of different questions around pensions. That's one of the key areas. I'm not going to give you all the answers in this video because it'd be a very, very long video. What I am going to do is take a deeper dive into many of these areas in the future. So yeah, look out for future videos. I will literally take a deeper dive into a lot of these areas. But today I just want to touch upon those. So pensions is one of the easiest wins. You can generally put up to 40k a year into a pension. That's probably more than enough for most of us in terms of how much we can afford to put in. It's not a secret that the earlier you put into a pension, the better. And it'd be fair to say, if I'm summarising, there's definitely tax efficient ways of putting into a pension. If you're a high rate taxpayer, normally that is one of the easiest ways to reduce the amount of high rate tax that you're paying. Even if you're not a high rate taxpayer, still a lot of benefit in that. And by the way, I've just realised my picture. The lighting's a bit funny on the video, but also I've got pink background because I'm actually doing this in my daughter's room at the moment, not in the office. It's just got the best window really, so that's why I'm recording it there. So I'm not going to go into too much detail with salary and dividends because a lot of people are aware of those. But if you're a new business and you're not, typically going to have a lower salary with higher dividends. And the important thing can often be the timing of these dividends. If you have a company year end that's not the same as the tax year, so if it's not March, if you've got like an April, May, whatever month of the year your limited company year end is, you can sometimes be a bit clever with the timing of how you allocate those dividends, because they can fall into a different tax year and there's a bit of flexibility there. It's one of the benefits being limited, and you can potentially defer your tax. Ultimately, you're still going to have to pay it, but there are some planning opportunities there in terms of your company year end. If you can employ a spouse, great. I'll cover this in another video, and gifting share. So often we think about husband and wife. We think about husband and wife, but there can be opportunities for other children or other relatives in the business to potentially be a shareholder, and it's a very tax efficient way to keep more money in your family's pocket as opposed to the tax man. So don't rule out looking to the wider family. That there's obviously some politics and things that need practical points that need to be considered, but that's definitely a potential easy win. Definitely if you've got a child who's 18 and older, that doesn't earn much income elsewhere, that can be a really easy way of saving tax. Loans, so you can receive a tax-free loan from your business for £10,000 per annum, and there's no P11D, no personal benefit. It's not always something you could and should do, but there can be opportunities to pay yourself a loan as opposed to a dividend or a salary if it's going to save you high rate tax, or if you've sometimes if you've taken a bit more money out of the business than it can afford. That's a different video altogether, because that's all to do with directors' loan accounts and overdrawn directors' loan accounts. But there can be tax efficient ways to use that as a vehicle, and even to go beyond the £10,000, there can be some instances for that as well. In the early years, when directors' loans and this whole concept come about, football players used to really abuse that and treat everything as a loan, and there was tax efficient ways to write that off as opposed to being a salary or a dividend. Personal use of company assets. So this is something to just be aware of. So you might also have the opposite way round. You might have where you have something you're using for the business you pay personally. Make sure you don't miss out on those assets, and make sure that you're getting the full entitlement you're due. And just because you pay for it personally doesn't mean you have to lose out for tax. So there's definitely some smaller areas to consider. But the whole point of the 32 ways to save taxes, there's some what I call rocks. There's some really big things that can get some easy wins. But also all of the smaller areas can add up. They might be smaller individually, but they add up to a significant amount together, not just for that year, but for the long term. If we're talking something on its own we're talking hundreds, but collectively we're talking thousands. Over a 10-year period, we're talking tens of thousands of pounds potentially. So don't rule out things that even seem a bit smaller at face value. And there are some tax efficient benefits you can receive as an employee of your own business. It's worth pointing out that if you're not a limited company, not all of this is going to be as relevant to you. So if you're self-employed, dividends doesn't mean anything to you. Salary doesn't really mean anything to you, because your profit is your income. There's not really such a thing as salary and dividends generally. But a lot of the other things will still be valid in terms of splitting income as a family, paying partners a salary. But generally speaking, I'm going to be aiming this towards limited companies. The 32 ways to save tax, but it is relevant to many self-employed people. So employee benefits. So there's things like trivial benefits where you can have a certain amount tax-free each year. You could just pay yourself and a staff member a certain amount for pretty much anything, and it's classed as trivial, tax-free. Rent. So rent can, obviously in its literal terms, if you're paying for business premises, that's an allowable expense. But also if you're working from home, we want to make sure you maximise. Again, that's a topic probably worth doing a separate video. But we want to make sure you can maximise the amount of rent, or what we call working from home, use of home as office, entitlement that you can. And there's 2 or 3 ways to actually figure out what you're entitled to. So the key is to maximising what you can justify to the taxman, and there's ways to go around that. And sometimes you can actually go above and beyond what is the ideal number. Because even if it's taxable, so you can, for example, if I'm working from home and I could justify £1,000 per annum as an expense, I'm just making up that number. Sometimes it's a lot lower, sometimes it's a lot bigger. But if it's £1,000 per annum, there can be an instance where actually I can still pay myself £5,000 on paper as a rent for the business use, but what that means is a proportion of that, so the 4,000, because it's more than what's commercially justified. Because if £1,000 is commercially justified, and I pay myself £5,000, 4K is over that limit. That's taxable income to me personally. But sometimes it can be more tax efficient to receive a rent than it can to receive a dividend or a salary. So you can get quite creative when it comes to rents. It's just something to consider there. So they're all the main easy wins, I'd say, in terms of 32 ways of saving tax. But there's other things to think about. Home working expenses we just touched upon, so there's a bit of an overlap there. There can be some differences, because rent doesn't necessarily just mean working from home. There can be vehicles of properties you own as well. So I've sort of touched upon home working. Mileage claims, don't miss out on your mileage claims. You can claim 45 pence a mile up to 10,000 miles per annum. Then it's 25p a mile. There can be instances where you can increase the 45 pence rate if you have different vehicles, I believe, as long as they haven't changed the rules. But don't miss out on your mileage claims. There are some apps that can track it, whatever's easier for you, whether it's a spreadsheet, an app. Something electronic's probably better, because if you lose it, you can't really lose it, can you? It's stored in cloud typically. And also, if you're doing a personal trip, can you make it a business trip? Can you travel somewhere to turn a personal trip into a business trip that makes it an allowable expense? If you could do that on a regular basis, it adds up. Points rewards card. So if you've got a brilliant example is air miles for credit cards. If I think Virgin has some really generous air miles for traveling. And I do know a business owner that pretty much flies first class every year for free on holiday because of the points he's earning on his card, because he's got a business credit card, and he's running a lot of expenses through that credit card that's earning him those rewards that he's enjoying personally. So that you can be quite creative around the rewards. That you can find anything on YouTube nowadays. That there was some guru who knew everything about rewards and what credit card to get, so you can probably take a deep dive into that. So business travel, I've touched upon that. Can you make but just moving beyond mileage, just business travel in general, can you make a personal trip a business trip? If you're traveling abroad for some personal benefit, can you go to a training conference? Can you have some sort of networking meeting? Can you meet a prospect? Can you do some sort of research that has a business connection to it? So you can, it's not to say your family trip to Florida can be claimed for business. I'm just checking my battery on my computer. It's not to say your business trip to Florida can be claimed for business, but you can be creative. Don't rule out, turning a personal trip, particularly if it's just yourself and maybe your wife who's employed by the business. If it's your whole family, it's probably a bit more difficult to justify. And our approach to all of this when it comes to tax, and it's been the same since I've started my own business about 8 years ago, is as long as we can justify it to HMRC, we would generally push to claim something in your favour. Because we've got two jobs. One is to make sure you're compliant, it's done properly, and everybody can sleep at night, but also to reduce your tax as much as possible, and as long as we can justify that to HMRC. And that's where an accountant, that's where we come in, because we use our experience for the second part. It's not just here's the rules, this is what you have to do. It's, for want of a better word, I've never found a better way of describing this, is what can we get away with legally and justify to HMRC. So I wanted to keep it to about 20 minutes. Just want to touch upon some other areas. Amazon Prime subscriptions, if you're getting lots of business deliveries, if you're listening to purely business audiobooks, there can be an instance where even that can be allowable, but that's a smaller one. There can be some, vehicles to be a bit more creative about university fees. It can get a bit more specialist and complicated because it involves trusts typically. But don't rule it out. If you're a high earner and you're paying a substantial amount in school fees in a private school, definitely something to think about. Life insurance, some life insurances can be allowable, like keyman insurance, relevant life insurance, I think is called. So some life insurance that can be allowable. Paying for pensions advice for an employee of your business can be allowable. Mobile phones, I mentioned trivial benefits. This is loosely connected. Gifts under £50. Staff functions. So you could be, if it's yourself in the business and your wife, you could be having a board meeting when you have a meal, potentially, as long as it's not too frequent, it's not kind of taking the mickey. All these things add up, and like I said, over many years, we're talking potentially thousands of pounds. Workplace training, some smaller things here as well. Company cars is an interesting one. Generally, I will do a separate video for this, and there is a blog post on our website. But generally, company cars have not been tax efficient for many years, because what happens is it's an allowable expense for the business, but it's a taxable personal expense for the person, the employee, who's receiving a free company car. So the business can claim it, great, but the individual gets clobbered for tax. So generally, it's not tax efficient to have a company car. Commercial vehicles are different. Things like vans, taxi drivers, trade-related vehicles are fine. But it's changed slightly in the last couple of years. If you've got a fully electric car, it's a consideration. If you're seriously considering going the electric route, company cars are back in the conversation, and because long story short, there's only a 1% taxable benefit on an electric car. It was 0% last year, and there's a 1% benefit now. People often ask me, is it better to lease or get a hire purchase? A deeper conversation, but typically the tax element is pretty much the same. So just look at the finance arrangement. What's the best deal for you, really, and your family? It's great if you can put electric car through the business in a tax efficient way. But if it's costing you 50% more to get that electric car, it's still not going to make you better off in terms of your personal wealth. So don't just think about the tax, think about the actual cost as well. That's the main ones. So I'm pretty much done. This video is not about trying to say, come and speak to us and sell extra services. But going back to my original point, a lot of accountants do not allow the time to take a deep dive into your circumstances. If you feel that particularly if you're a higher earner or you're paying a lot of tax, if you feel that you're missing out, then what we do for clients is we do what's called a tax diagnostic. For existing clients, you might have heard of this. This is a fairly new thing we're offering. And long story short, we take a really deep dive into the 32 ways. So we actually put together a super detailed report based on everything that's relevant to you. There's actually about 1,000 different tax reliefs. So tax is complicated. There's no 5-minute fix in terms of this is what you need to do when it comes to tax. It's something you need to stay on top of, and something that changes depending on where you are in your business journey. So if you've not really had a deep review since you started business, then for a lot of people it's probably worth it, to be honest. So we call it a tax diagnostic. So what happens is we do a lot of fact finding, we ask a lot of questions, and we arrange a meeting to go through that with you. Initially, we perform the analysis, and then we arrange a date to follow up, a 30-minute call to go through what we found. And then what we do is we give you recommendations, and we point out the areas that we feel you can save tax. And often we can even identify some figures for you. It's not always possible, but we will give you basically a proposal to say, this is what we feel you should do. And the reason why we can't just summarize up a kind of one shoe fits all, because there's so many different areas, everybody's report is different, and that's why we need to do the report first, because it might be that actually there's some easy wins in terms of your family and your shares, your pensions, your loans, but that might not be applicable to someone else. For someone else, it might be about rent because they have a premises, or it might be that they do a lot of international traveling, and we can try and be a bit more structured around claiming business expenses. And it might be that they've got employees in the business, and there's a more tax efficient way to pay your staff. So it really depends on the business owner. So that's why we do that report. We discuss your recommendations for you personally, and then we have a chat to go through exactly what's going to happen. If you want to know what the fee is, just give me a shout. But ignoring all of that, even if you take no action, just have a think about it for yourself. Okay, even if you don't want any help from us with these 32 ways, just have a think about it for yourself. Because some of these are probably going to jump out off the page that you feel you should be looking at. And yeah, if you want to discuss just one of these things specifically, if you just want me to go deeper into loans, dividend planning, pensions, let me know, and perhaps we can do another video, or we can have a follow-up chat. So hopefully this has been of use to you. And the plan moving forward is to do some videos on the different areas of the 32 ways. So we're going to look at pensions. We're going to cover salary, even though that's quite fundamental. Some people are not doing their salaries correct. If you're a client of ours, you will be, because we're doing your payroll. But if you're doing your own salary, you might not be. It might not be as tax efficient and optimized as it could and should be. We'll look at, what else will we look at? I'll just give you a heads up for the areas. But we'll look at home working expenses, because that's quite a common one. We'll look at business travel. I think the pensions is definitely a big area we'll also look at. But yep, so we'll take a deeper dive. And I think company cars is probably another interesting area. So thanks, guys, and bye for now. Cheers.